Picture this. It's any quiet morning. You and your partner are sitting at the kitchen table, and you've just transferred £1,800 to your landlord. £1,800. Gone. And then, out of pure curiosity, you open a mortgage calculator, and the bank tells you that you cannot afford the monthly repayment on a home of £1,200 a month. Read that again. You are trusted to pay £1,800. You are refused at £1,200, £600 cheaper, and the answer is still no. This is the rent paradox, and in 2026, it is the single most infuriating equation in British life, because it means the British dream is no longer blocked by how hard you work or how much you earn. It's blocked by a mathematical wall, one built for a different economy, a different century, and frankly, a different country. Today, we're going to show you exactly why the door is locked, and more importantly, where the manual override is hidden. Let's start with the wall itself. It has a name, the income multiplier. When you apply for a mortgage, the lender doesn't really care what you currently pay in rent. They care about one number, your gross income multiplied by 4.5. That's it, 4.5 times. Whether you're a single applicant or a couple, that multiplier barely moves. So let's do the math the bank does. Take a strong, dual income couple earning £70,000 a year between them. Multiply by 4.5, and the ceiling appears, £315,000. It sounds like a lot until you see what it actually buys. In much of the south, and certainly anywhere near London, that number doesn't buy a family home with a garden. It buys a flat, often a leasehold flat, with a service charge that quietly eats another few £100s a month and a ground rent on top. You've done everything right, 2 salaries, good careers, and the system has capped you at a 1-bedroom compromise. But it gets tighter still. Even at that 4.5 multiplier, the lender runs one more check, the stress test. They don't ask whether you can afford today's rate. They ask whether you'd survive a storm. So even if the actual product you're applying for charges 5%, the bank stress tests your affordability at 7 or even 8%. If rates spiked overnight, could you still cope? And that invisible, higher rate quietly shrinks the number they'll lend you before you've even started. Here's how it feels. Imagine standing in front of a mirrored door. Through the glass, you can see it. The life you want, the kitchen, the spare room, the life you're already paying for, right now, through your rent. But the door has an entry code. And the code isn't your effort, or your ambition, or how many extra shifts you pick up. The code is the multiplier. It's the shape of your salary. And here's the cruel part. You can shout. You can work harder, longer, later. But the lock doesn't respond to volume. It doesn't care how loud you are, or how badly you want it. Your salary simply isn't the right shape for the lock, and so the mirrored door stays shut, reflecting your own tired face back at you. Fine, you say. I'll just save a bigger deposit. And this is where we have to be honest with you, because this is the trap that catches the hardest working couples of all. Saving, on its own, is no longer enough. Here's why. The average UK home now costs roughly 8.5 times the median household income. 8.5 times. A generation ago, that number was closer to 3 or 4. The finish line has physically moved. Now layer on the movement. If house prices rise by even 5% in a year, then a £315,000 target grows by nearly £16,000 in 12 months. Your 10% deposit is chasing a number that's running away from you, and the deposit isn't even the only upfront cost. On top of it sits stamp duty, legal fees, surveys, thousands more the calculator quietly forgets to mention. So you're saving for a moving target, and you're doing it while handing over more than 35% of your joint net income in rent every single month to the very landlord whose asset is appreciating while yours doesn't exist yet. You're not saving, you're treading water in a rising tide. Now let's talk about the invisible anchor, because it isn't just your income the bank weighs, it's your commitments. And nothing drags an application down quite like a PCP car agreement. Here's the number that shocks people. A single £400 a month car payment, that shiny PCP deal, the one that felt so affordable on the forecourt, can reduce a couple's total borrowing power by nearly £25,000. £25,000 of house, gone. Not because you can't pay for the car, but because the lender treats that monthly commitment as income already spoken for. Add student debt on top, factor in how HMRC deductions shrink your take-home, and the anchor gets heavier still. You didn't feel poorer when you signed the PCP, but the mortgage machine did. That car is quietly holding you one full rung below the ladder. So let's put the whole picture together with one image. Renting, while trying to buy, is like trying to run forward on a moving walkway, one that's traveling backwards. Your rent is the speed of the walkway. If that walkway is moving against you at 4 miles per hour, your rising rent, your rising target, then you have to run at 5 miles per hour just to move one single inch closer to the exit. Most couples are running flat out at 4 miles per hour, which means, mathematically, they're standing perfectly still. Exhausted, sprinting, and going absolutely nowhere. That isn't a personal failure. That's a designed feature of the machine. And now, the decision no one talks about honestly, where you live. Staying near family, in the home counties, has quietly become a wealth tax, a tax you pay not to HMRC, but to geography itself. The emotional pull is real. You want to be near your parents, your friends, the streets you grew up on. But in the home counties, that 8.5 times multiple can stretch toward 10 or 11 times local income. Staying put means paying a premium measured in decades of your working life. Move 2 hours north, and the same £315,000 suddenly buys the garden, the driveway, the spare room. The wall doesn't disappear, but it gets a great deal lower. The uncomfortable truth of 2026 is that, for many couples, proximity to family has become a luxury good. So, is there a manual override? Yes, several, and they're all about playing the machine's own rules better than it expects. First, LTV optimization. LTV, loan to value, is the ratio the lender obsesses over. The moment you cross a threshold, say from a 90% LTV down to 85, the interest rate you're offered can drop noticeably, because you now look like less of a risk. Sometimes finding one final chunk of deposit to cross a band saves you more than months of overpaying ever could. Don't just save blindly, save to a threshold. Second, use the tools built for exactly this fight. If both partners open a lifetime ISA, the government adds a 25% bonus, up to £1,000 each, every year toward a first home. Two partners, saving in parallel, becomes a serious state-boosted deposit engine. Just remember the property cap sits at £450,000, so it fits most of the country outside the very hottest postcodes. Third, cut the anchor before you apply. Ending that PCP agreement before the affordability assessment can hand you back that £25,000 of borrowing power and guard your credit score in the months beforehand. No new credit, no missed payments, nothing that makes the machine flinch. And once you're in, watch the calendar. When a fixed deal ends, you roll automatically onto the lender's SVR, the standard variable rate, which is almost always punishingly high. The machine keeps charging you the moment you fall asleep at the wheel. None of this changes the 4.5 multiplier, but it changes the shape of your salary going into the lock, and sometimes that's all the door needs. So here's the truth we want you to leave with. Home ownership in Britain is no longer an individual race. You aren't slow, you aren't lazy. You're running on a walkway built to move against you, in front of a mirrored door coded for an economy that no longer exists. But understanding the machine is the first step to beating it. Know the multiplier, watch your LTV bands, cut the anchor, question the geography, and use every tool, every lifetime ISA, every threshold, built for people exactly like you. Because wealth, real wealth, isn't the flat or the driveway. Wealth is the moment you stop being a passenger in your landlord's future and finally become the driver of your own. If you learned something, like and subscribe. I'll see you in the next one.